Shane, on the inflation front, OPEC Plus dispute when it comes to raising output, that may weigh on the inflation picture as we could see consumer spending being dented. Now, pulling up the chart on the terminal, we're seeing some of these concerns come through with the correlation between the S&P 500 and Brent, which is negative for the first time since 2017. Now, given the potential implications on demand and corporate earnings, when will higher oil prices ring alarm bells for stocks, Shane?
Well, that's a good question. You could argue that the rise in oil prices we've already seen has been a contributor to some of the inflation scare we've seen over the last few months. So you could argue it's already starting to impact to some degree. I think at the moment, though, the positive impact on energy shares is sort of outweighing the broader impact for the market. I guess the question is how much faster it goes up from here. I think this gradual creep higher to some degree has been absorbed by the market because it's not seen as a major problem for inflation in the US, but if it continues and accelerates, perhaps because OPEC can't reach a deal in increasing output, then obviously that would be a concern. But as we've heard, these concerns in OPEC do sort of go both ways. On the one hand, you could argue, well, that could mean less supply in the short term, therefore higher prices. But on the other hand, if OPEC's discipline breaks down as a result of this dispute, then it could mean lower prices over time as they individually pump up output. So it's a bit unclear as to which way that one will ultimately go.
Now, inflation, a key consideration, of course, for central banks. Ahead of the Fed's meeting minutes on Wednesday, the latest payrolls report out of the U.S. showing a pickup in the employment rate as more people entered the job market. What's the path then for Fed tapering and eventual tightening?
Well, our base case is and remains that the Fed will start formally discussing it either at its next meeting or the one after, but by the end of the year or early next year, we'll start to see tapering commence. I think it's probably more a 2022 story, but I think by early next year, tapering will have started. We've got to be a little bit balanced here because don't forget, as we saw in 2013, the initial talk about tapering, as we saw earlier this year, can cause volatility in markets, but the reality is the tapering is still monetary easing. It's just at a lower rate. They're buying less bonds than they previously were. So it's not yet a monetary tightening, but obviously it does eventually head in that direction. But my take on all of this is that the jobs figures on Friday weren't enough to change the Fed's perceptions on things. They would be happy that the recovery is proceeding, the jobs market is continuing to recover. But by the same token, they would also look at the fact that employment in the US is still more than 4% below its pre-coronavirus level. The participation rate, the number of people in the workforce, still remains pretty low. There's a lot of people being held back by particularly the enhanced unemployment benefits. And as reopening occurs and those unemployment benefits come to an end, then you'll see the labour supply pick up. So there's a bunch of things in there which suggest that that was pretty much a Goldilocks jobs report. Good news, recovery continues, but it's not so strong yet. There's still a fair way to go before you can say that the Fed will get too concerned about it. So my take is that yes, tapering will start end of this year, early next year. It'll be a gradual process. It'll be well flagged by the Fed. And then, of course, rate hikes probably won't commence till 2023. But there was nothing on Friday's jobs figures to change that.
In the meantime, Shane, where we are, of course, almost half the Australian population is still remaining under these stay-at-home orders. To what extent is the Delta variant and the ability to manage that a key differentiator for market outperformance in this region?
Well, it could, yes, it probably is causing a lot of nervousness. This region doesn't have the degree of immunity that other countries have because we haven't had as much coronavirus, for one thing, and we're not as vaccinated as North America and Europe is, and UK is. So that could cause a short-term setback. But if the production plans from the major vaccine producers are accurate, and we do see 10 billion doses produced this year, then I think you will see the supply of vaccine across this region start to pick up. I think you'll see vaccination rates pick up. And therefore, these concerns we're currently seeing, I think, will gradually start to abate. I think the other thing you note about this region is it is quite adept at controlling coronavirus in the absence of vaccines. We have seen across Australia these snap lockdowns. The evidence is that they work. We're still waiting in relation to New South Wales. That one may go for a little bit further. But the fact that the lockdowns were commenced relatively early in terms of the number of cases does provide a little bit of confidence that they can also end early, as we've seen in some of the other states around Australia. The other aspect, I guess, you've got to accept in Australia is that a big chunk of the older population has been vaccinated. So therefore, the fear factor associated with it in terms of deaths and illness, particularly in nursing homes, hopefully shouldn't be anywhere near as bad as it was last year, and hopefully not bad at all. Fingers crossed on that one. But that is one factor, just bearing in mind that the vaccination rates amongst older people, people in nursing homes, is different to the situation a year ago.
Is your view then that sets the RBA up still to gently start tapering regardless of the lockdown situation?
I think so. I think when the RBA meets tomorrow, they will make some steps towards exiting from ultra-easy monetary policy, but it will be baby steps. I do think they'll probably announce something in relation to their bond buying, either slowing the pace or making the reviews more frequent than 6 months, or some combination of the two. But by the same token, they probably don't want to add to uncertainty in this environment. So I think their commentary will remain fairly dovish. And so that, I think, is the key in this. Baby steps tomorrow, but ongoing dovishness from the RBA. Our view remains that they won't start raising rates till 2023. But I don't think they want to signal anything more aggressive on that front. And they'll probably try and stick to the 2024 horizon out of the meeting tomorrow.